Welcome, everyone, to Real Estate 360 Live with Ryan Sloper. For those of you not familiar with the show, my guest and I will cover every angle of real estate under the sun, from interest rates to the economy to what's happening in Washington. Anything that affects our real estate market locally. If you have credit issues, you can call me. If you want to refinance to the lowest rates in U.S. history, reach out to me. I will gladly put you in touch with the loan officer that can assist you in getting those all-time low rates. You've got questions, and I've got the answers. Make sure you join us every Monday at WNEW 1580 AM from 2 to 3 p.m. in the afternoon. And you can call with any questions at our off-air phone number. It's 877-245-2030. That's 877-245-2030, or via the web at realestate360live.com. That's realestate360live.com. Remember, if it's real estate, it's covered here. We've got a great show lined up for you today. We're going to be jumping into employment numbers from last Friday, and it looks like the numbers are showing that the economy is turning around. I'm not so sure about that, and I'll tell you why. We're also later in the show going to tell you how to properly gift money for people that are trying to obtain a mortgage and they need a gift for a down payment. There's a proper way to go about doing that, and we'll tell you, give you the skinny on what you need to do to give that gift. Also, we're going to let you know why you should be paying attention to what's going on in Greece right now, and how that can tremendously affect interest rates up or down one way or the other, depending on what actually takes place with this package that they're trying to get put through. And also, we're going to let you know why about almost 20% of all real estate deals are falling apart today. We're going to give you the ins and outs to let that not be an issue that you have when you're trying to purchase your brand new home. And lastly, we're going to have in our Credit Fix segment where our credit expert, Ronnie Lambeth, jumps into explaining about bankruptcies and how that affects your credit. Joining me on our panel to discuss these issues and many more is Louis Cammarosano, who's the general manager of HomeGain. Louis is often cited in the media as an industry expert in the Wall Street Journal, Forbes, CNN Money, Fox Business, Smart Money, MSN, and numerous others. We're going to discuss with you what happened in the markets last week, as well as what's on deck this week that can affect you and your real estate decisions. Louis, how you doing?
Good morning, Ryan. How are you today?
I am doing well, sir. I was out at a Super Bowl party, as I'm sure many other people were last night. Little tired this morning, just because they got these games starting at 6:30 at night. It's a little late.
Some people start the pregame at 10 in the morning, or maybe even earlier, so there's a lot of bad food and drink going on, right?
Yeah, absolutely. The crazy part, Louis, is like the pregame show lasts longer than the actual game.
Oh, absolutely.
I mean, the buildup is for days, and I mean, from the time I turned on my TV, I want to say it was like 10 o'clock in the morning. It was on until you went to bed. So it's definitely the thing that steals the show for any other television shows, at least for Sunday.
You don't get a break as in a normal. You walk out during the commercials. People pay attention to those commercials as much as they do the game. And then the halftime show also has people riveted. So the entire time, people are watching the TV set and eating chips and drinking beer.
Absolutely. It's definitely, it's interesting. I think they said something like the average 30-second commercial cost $3.5 million this year. I mean, there is a boatload of money getting spent, during the commercials that run. It's just amazing to me. I guess there's been a lot. It kind of says with the state of the economy. I guess they were expecting there to be a lot more companies that would actually want to run ads, and they didn't. So
it'd be interesting to see if advertisers can actually get people to pay attention to their ads more than one time a year.
Yeah,
because most people walk out during commercials.
Absolutely. They actually said, I think it was Chrysler. They ran commercials not this Super Bowl, but last Super Bowl, and actually had tremendous success. Now, how they were able to link that commercial, spawned a ton more sales, I don't know. But they actually, had another commercial this year that had Clint Eastwood in it, and they said that they had gotten a lot of traction out of that commercial. So I guess some of these companies that are running, interesting and compelling marketing ads, it's actually a benefit to them.
Well, they should probably do that year-round. Also, there's an aftermarket for the Super Bowl ads. People vote on which ones were the best, and there's a whole YouTube community that views all the different Super Bowl ads. But they don't do that with the ads during the rest of the year, which means they put a lot more time and effort into their advertising during the Super Bowl than they do the rest of the year.
It is interesting, isn't it? It's like, what if you spent that much time marketing through the whole year? I bet you your business would probably be doing a lot better.
Sure.
We got a lot of...
And in fact, you're competing against other great ads during the Super Bowl. If you just put in that effort during the year, when the mediocre ads are out, your ad would really stick out.
Yeah, I mean, it makes sense, and you're not having to pay near as much. $3.5 million. I mean, good grief for 30 seconds. That's crazy. Right now, where the market sits, Lewis, we got the Dow down 45 points today. Nasdaq's up 7. The 10-year yield is at 1.89%, so it's still below 2%.
That's ridiculous.
I know. We have the euro, which is right now priced at $1.31. And obviously that's been trending down because of all of the concerns over Greece. And it's just like Greece, I think at the latest that I saw is they're actually pushing it back another day. They have to make it. They were supposed to make a decision for, weeks and months and years now, but now it's tomorrow they're going to make a decision. And
Ryan, I think with Greece, we've been hearing about Greece for months, maybe even a year now. They should just get over with it. They should default. That would send a signal to the markets for lenders to be more cautious with their money. That would cause rates to go up because investors would demand more for the risk. The only reason Greece was able to borrow at low rates was because it was part of the perceived safety of the euro. And then once rates go up, governments have to spend less, and we'll start to see a recovery. But right now, we just keep putting it off. The best thing to happen would be for Greece to default, even if it means certain creditors who are holding the Greek paper go under.
Absolutely.
Because eventually it sends a signal to the market that these sovereigns, if they can't pay, you shouldn't lend money to them, especially at these rates. And if you want to lend money to them, you have to lend it to them at a higher rate. And if higher rates mean the government can't borrow as much, well, then they'll have to spend less.
Yeah, I mean, I wholeheartedly agree with you there.
Look at the U.S. I mean, we can borrow money because the rates are low.
Yep. Yeah. And that you bring up an interesting point, Lewis, because a lot of people are asking me, okay, well, why should I care about what's going on in Greece? And I said, well, actually we don't necessarily care what's going on in Greece, but it does have effects here in the United States, and it's affecting that because people are taking and instead of investing over there, they're actually taking and pulling their money out and investing in treasuries and mortgage-backed securities.
Unfortunately, if Greece does default, people won't pick up on the fact that the U.S. has the same problem as Greece. More people will buy U.S. treasuries because of the perceived safety, and rates will go further down.
Absolutely, and that's
the opposite of what should happen. But we've seen in the past that the flight to safety doesn't really involve large amounts of capital going into assets such as gold and silver. It flows into treasuries either through private investments or the Fed purchasing the securities to keep the rates down.
Yep.
That game can't go on forever.
No, definitely not. And it's just amazing to me. I mean, you and I have talked candidly that we're like, well, why do people think that the U.S. is safe? And I guess it's just a matter of, it's the only option at this point because there's so much other stuff going on in these other countries that people are just there's a perceived safety net with the United States.
Yeah, you have a global debt crisis, and people seem to think, and it's probably correct, that it'll end up on the U.S. doorstep last.
Exactly.
That doesn't mean it doesn't have the problem. So I guess people take the perceived safety while the other countries and sovereigns go under or will go under. But the U.S. isn't going to be immune from the debt crisis. What's going to happen is they're either going to have to, and which surely they'll do, they'll inflate their way out of it. They won't default, whereas other countries won't be able to print up the difference, either because they're restricted by, for example, Greece can't print up the difference because of the euro. They're going to have to default.
Yeah.
And I guess the safety in the U.S. is at least you'll get paid back. I mean, Greenspan was on TV that one time about 3 or 4 months ago. He said the U.S. will never default because they can always print the difference.
Yeah, and that's been going on for some time now. And that's like
That's an effective default because you're receiving worth less dollars. I don't mean worthless meaning they're not worth anything, but they're worth less than what you put in because of the inflationary impact of printing money.
Absolutely. Just for those of people that aren't not familiar with the deal that's on the table in Europe right now, it's basically calling for Greek bond investors to exchange the outstanding bonds for new ones with coupons as low as 3.6, 3.75% and take losses of about 70% in the process. If most private investors don't agree, it could trigger credit default swaps on those securities, leading to European bank liquidity issues. So,
and Ryan, wouldn't it be better that there's a deal on the table that would avoid a larger catastrophe to take a haircut? And what's happened is most creditors don't expect to take haircuts from sovereigns. They expect to be bailed out and be paid in full. That's what happened in 2008. Goldman Sachs was paid in full when their credit default swaps were uninsured by AIG.
Yeah, these bailouts have just become, it's almost like commonplace where it's more expected than anything else.
Well, that's priced into the risk.
Yeah.
And it shouldn't be. If the market priced in the risk that Greek government can't pay, then they'd have to charge higher rates.
Yeah, and that's, but that's right now with this going on. And now we, like I said, we have the 10-year yield at 1.89%. And it's interesting because I keep getting, and, you and I talked that we, ultimately we think our long-term forecast for rates is up. But with all this going on, it's actually been helping interest rates. They've been getting
short term for sure. And that's why we've been saying that if you have a home that you want to buy, don't wait around for interest rates. You may have other considerations why not to pull the trigger. But interest rates really have nowhere else to go but up. They could go down in the short term, but they're not going to go down dramatically.
Absolutely. If you're in the market right now to purchase or refinance your home, and most of the time I'm telling people, just as a rule of thumb, if you're paying above 4%, at least call to figure out what your options are. The phone number is 877-245-2030. The number is 877-245-2030. I'll put you in touch with a loan officer that will go over your situation and let you determine if it makes sense. I mean, most of the time, people are paying, 5 to 6% interest. If you're not underwater, then you should consider refinancing. Now, I know I must field, Lewis, probably 30 calls a week that are, well, I'm underwater. My loan is not owned by Fannie or Freddie, and I don't have a VA or an FHA loan where I could do a streamlined refinance. So what do I do? And unfortunately, the answer as of right now is you can't do anything.
Other than not pay your mortgage and hope that the bank comes back to you and works something out.
Correct. And I will tell you
that, so now they haven't really been willing to do it. Seems.
And you actually bring up a good point there too, Louis, because I actually had a client that was dealing directly with their bank to try to get a modification. And when it started out, they had said that, we'll just fill out this paperwork. You're going to have to give us your bank statements and all that. We're going to look and see if you're going to be a candidate for it. So they started along that process and then determined at some point that they had to go late before they would start negotiating with them on the modification. Well, they went late. And then after all that was done, this paperwork has been processed over probably, I'd say, about 90 to 120-day period. At the end of all of it, they ended up not even doing the loan modification. So,
you know why that is, Ron? We've talked about this, is the banks, if they were to start to write down loans due to a large number of a percentage of their portfolios as loan modifications, they would then have to mark these loans down, and again, they'd appear to be insolvent, and they'd have to do a bailout. So in a way, the new accounting rules that allow, I think they put them in place a couple of years ago, that allow the banks to keep these performing loans or underperforming loans on their balance sheet as performing assets, even though chances are they're never going to get paid, allows the bank to appear to be solvent when they're not. So in a sense, it's kind of an accounting rule bailout, but it masks the reality that the banks really aren't going to get this money.
Yep.
And especially, and it acts as a disincentive to do the prudent thing, which is to modify a loan of somebody who's eventually going to go into default and foreclosure.
And that is actually the key, Lewis, is the accounting there. You know what? If the government actually wanted to allow banks to do these modifications and stuff, they would have to amend the accounting rules, not come in and try to force them to do the modifications and whatnot. It's like you said, they can't get around the accounting issues that they have. So,
well, they've gotten around them by the government allowing I think it's not the government, but there was some rule passed that under generally accepted accounting principles that they can keep the loans at the stated market value.
Right.
Now, if you were to change the rules to say, okay, go ahead and do a loan modification, but somehow, in order for the banks to appear to be solvent, but go ahead and keep them on your books at the full rate, that wouldn't make any sense either, though, because the reality of it would be they'd be taking less money in.
Yeah.
And the fact is, if their cash flow is lower than the stated amounts of the loans, I suspect that puts many of the banks into a bankruptcy situation because they really don't have the money coming in that they would claim to be having coming in if they were getting paid in full.
Yeah. What's interesting is that, a lot of the times I just say the bank should just be willing, especially if the borrower is willing to short sell or whatever, just take it back. Just take the house back if the borrower is willing to give it up and start moving on with the process instead of taking foreclosures that are averaging, up to a year plus for that to go through. I mean, they're basically, like you said, they're just pushing off that money to go to the next year.
Well, if the banks were nimble competitors, what they would do, they would see the opportunity in owning an asset such as a home, and they would actually create departments in banks that would actually take back the house and start renting them out. But the banks are not in the business of being landlords.
No, not at all.
Because there is money there, and that's how you solve the housing crisis, is to allow the home prices to drop, allow modifications to be done where it makes sense. If they can't make sense out of it, let them go out, and then have people come in, purchase the houses either for rent or to live in at lower prices, and eventually it'll stabilize the housing market.
Yep, absolutely.
That's how the free market would work, but that's not what's working right now.
No, it's not at all. We're up on a break, Lewis. When we come back, we're going to jump into the job market. It looks like it's heating up, but does that actually mean that the economy's turning around? Stay tuned when we come back.